What we see time and time again when studying history is that major economic downturns, or depressions, are often triggered by debt and liquidity crises. These aren't new phenomena, and throughout history, economies have managed to recover from these downturns. But the ways in which they do so evolve over time. One of the primary mechanisms of recovery is through changes in monetary policy, and there are different forms this can take. Broadly speaking, we can categorize monetary policy into three stages. The first form of monetary policy is relatively straightforward: adjusting interest rates. When interest rates are lowered, borrowing becomes cheaper, and this helps stimulate economic activity by encouraging businesses to invest and consumers to spend. But when the interest rate reaches zero, central banks can't lower it any further, leaving them to look for other ways to spur the economy. This leads us to the second form of monetary policy. Monetary policy 2 involves printing money and using it to buy financial assets. This increases liquidity in the economy, which can prevent a credit crunch, where businesses can't get access to the loans they need to operate. By buying these assets, central banks aim to support asset prices and stabilize the financial system. But there are limits to how effective this policy can be, particularly when the broader economy is struggling with systemic issues such as a massive buildup of debt or low consumer confidence. This is where the third form of monetary policy comes into play. Today, we're in what could be described as monetary policy 3. This involves central banks printing vast amounts of money and using it to buy government bonds. By doing this, central banks are directly financing government deficits, ensuring that money flows into the economy in a way that benefits those who typically wouldn't have access to capital through the normal financial system. In other words, this kind of policy aims to put money in the hands of people who need it most, often through government programs or stimulus packages. This kind of monetary easing isn't new. If we look back through history, especially into the 1800s and beyond, we see similar measures being taken to alleviate financial crises. When interest rates hit zero, it doesn't mean that the economic depression is set in stone. In fact, these depressions often don't last because governments and central banks always find ways to ease the strain on the economy, often by printing more money. However, there is a catch. While this approach can prevent a prolonged depression, it often leads to a depreciation in the value of money. The newly printed money may not retain its value, and we could see inflation rise as a result. In the end, though, governments and central banks will always turn to some form of easing, and this typically leads to a reflation of the economy, meaning that economic growth resumes, often at the expense of currency depreciation. Historically, this process has played out in various ways. For example, on March 5, 1933, during the Great Depression, President Franklin D. Roosevelt announced the severing of the U.S. dollar from the gold standard. This devaluation of the dollar was meant to give banks the liquidity they needed to repay depositors and help stabilize the financial system. Similarly, on August 15, 1971, President Richard Nixon made a similar move by severing the dollar's link to gold entirely, allowing the U.S. to print more money and manage its economy without the constraints of a fixed currency value. More recently, in November 2012, Mario Draghi, then president of the European Central Bank, made announcements aimed at stabilizing the Eurozone's financial markets during the European debt crisis. In the United States, we saw similar measures taken on April 9, 2020, when the Federal Reserve and Congress implemented emergency measures in response to the COVID-19 pandemic. These actions mirrored the responses seen in 2008 during the global financial crisis, where quantitative easing and government intervention helped prevent a total collapse of the financial system. These examples demonstrate that when interest rates reach zero, central banks don't simply stop intervening. Instead, they move to more unconventional methods, such as printing money and buying financial assets, including government bonds. These moves, while effective in providing immediate relief, have long-term implications for inflation and currency value. When central banks print large amounts of money, it tends to lead to lower real interest rates, especially when inflation starts to rise. Initially, we don't always see inflation pick up immediately. In fact, in times of economic downturn, inflation can remain low despite aggressive monetary easing. But eventually, inflation begins to rise, and we start to see the depreciation of the currency. This can manifest in different ways. Sometimes we see inflation driving down the value of money relative to other assets like stocks or real estate. Other times it shows up in commodity prices, such as gold, which often rises when people lose confidence in paper money. Take, for instance, what happened in 1971 when Nixon severed the dollar's link to gold. Inflation spiked, and as a result, real stock prices declined significantly, even though nominal prices might have appeared stable. This illustrates how the relationship between monetary easing and asset prices can be complex and unpredictable. As we see today, the Federal Reserve's actions are once again leading to a reflation of assets. The money being pumped into the economy is finding its way into equities, credit assets, and even commodities like gold. We may not know in real time exactly how inflation will play out or which assets will benefit most, but history tells us that this kind of reflation tends to follow aggressive monetary easing. In this environment, many investors might believe that holding cash is a safe option. However, this is a mistake. Cash, which people often see as a risk-free investment, can actually be one of the riskiest assets in times of inflation. As the value of money decreases, the purchasing power of cash erodes, making it a poor store of wealth. This shift in perspective is critical for investors. Traditionally, stocks and bonds have been the go-to assets for building wealth. But in a world where inflation is rising and central banks are printing unprecedented amounts of money, we need to think differently about where we put our money. Instead of focusing solely on equity returns, we need to consider a broader concept: the storehold of wealth. This means diversifying into different types of assets and locations that can better preserve value over time. To truly understand this shift, it's important to study historical periods that were similar to today. When we look back over the last 500 years, we see numerous instances where the value of money depreciated, and investors had to rethink their strategies. The lesson is clear: cash is not always the safest place to be, and what we define as risk can change dramatically in periods of high inflation. This brings us to the concept of diversification. In today's uncertain world, achieving balance in an investment portfolio is more important than ever. However, this balance doesn't just mean spreading investments across different asset classes like stocks and bonds. It also means diversifying across countries, currencies, and even commodities. The key is to create a portfolio that is resilient to the many unknowns we face. When we look at expected returns, we see a sobering reality. Across asset classes, the expected returns over the next decade are going to be much lower than what we've seen in the past. Whether it's stocks, bonds, private equity, or venture capital, all of these asset classes are going to struggle to generate the high returns that investors have become accustomed to. This is a direct result of the massive liquidity that central banks have pumped into the system, driving up asset prices and, in turn, reducing future returns. What this means is that investors will face a dilemma. Do you chase the low returns of individual asset classes, or do you focus on building a well-diversified portfolio that balances risk across different areas? The latter is the more prudent approach, especially in a world where the rules of investing are shifting. The reality is that central banks are not going to let the global economy implode without taking drastic action. They will continue to print money, buy assets, and do whatever it takes to prevent a collapse. But as we've seen, this comes at the cost of higher inflation and lower real returns. Take bonds, for example. If you buy a 10-year bond today, you know exactly what return you're going to get, often a very low one. This is a direct result of central banks keeping interest rates near zero. When you compare the returns of bonds to other asset classes, it becomes clear that expected returns across the board are going to be lackluster. The challenge for investors is that while returns are going to be low, volatility is likely to remain high. As we've seen in recent years, economic downturns and recoveries can be swift and severe, and they often come with significant market fluctuations. Central bank policies, which once operated within relatively predictable frameworks, now involve unprecedented measures, leading to unpredictable market reactions. In the past, the capitalist system worked by allowing free markets to allocate capital. Banks would take deposits, lend that money out to businesses, and earn a return on the spread between the interest rates they paid and charged. This system relied on the efficient allocation of capital by the private sector. Today, however, central banks and governments are playing a much larger role in directing where money goes, and this creates a different kind of volatility. This volatility isn't necessarily bad, but it does mean that investors need to be prepared for sudden changes in market conditions. Whether it's a downturn in the economy or a shift in central bank policy, these events can create swings in asset prices that require careful management. Given all of this, the best approach for investors is to focus on diversification and balance. No one can predict exactly how the future will unfold, but by spreading investments across a variety of asset classes, countries, and currencies, investors can mitigate some of the risks that come with today's uncertain environment.